Have you ever considered what it truly looks like when the complex, indifferent mechanism of the global financial system attempts to warn us? When the market's subconscious mind surfaces to scream a desperate final alarm before the breaking point? Because right now, in the quiet, clinical language of high finance, that scream is deafening. There is a signal, a stark, almost mythical indicator, that has materialized before nearly every catastrophic economic and financial disaster of the last century. It is the ghost in the machine. It is the shadow that preceded the Great Depression, the quiet menace before the dot-com collapse, the unheeded whisper before the global financial crisis of 2008. And today, it is not merely flashing. It is burning a hole through the fabric of the current financial reality. It is called the yield curve inversion, a simple graphical representation of a terrifying truth. For 100 years, it has predicted every major recession, achieving a predictive track record that is, frankly, unmatched in modern economics. But what we are witnessing now is not a normal inversion. It is deeper, more entrenched, and more extreme than anything recorded in the living memory of most investors. It shows us that what is unfolding may not just be an echo of 1929 or a rerun of 2008. It may be an economic event whose scale and consequence are far more profound. Because this time, the entire global architecture is built upon a towering, unstable mountain of debt, leverage, and dangerous illusion far grander than any past cycle. Stay with us as we dissect the geometry of fear and uncover why this ancient signal matters now more than ever. TUC2. Context. Historical setting. To truly understand the terrifying weight of this indicator, we must travel back to a moment when the world truly believed in permanent prosperity. The late 1920s. The world was dancing on a cloud of infinite optimism. The stock market was not merely booming, it was a societal obsession fueled by a dangerous combination of easy credit and speculative mania. People were leveraging their homes, their salaries, even their future, to buy into the endless upward trajectory. Terms like the new era and a permanent plateau of prosperity were not just headlines, they were articles of faith. Yet, away from the glittering skyscrapers and speakeasies, a quiet, almost invisible shift occurred. In 1928, the yield curve inverted. What does that cold, technical term actually mean? It is the purest expression of investor anxiety. Under normal conditions, a lender demands a higher interest rate, a higher yield, to lock up their money for 10 years than for 1 month. Why? Because the future is uncertain. This is the time value of money. But when the curve inverts, that logic is flipped on its head. Short-term interest rates suddenly rise above long-term rates. It means investors are demanding a higher return to lend money for a few months than they are for a decade. It's a fundamental breakdown of trust in the immediate future. They are betting that the financial pain and market instability in the short term will be so severe that central banks will be forced to drastically cut rates later. It is a desperate scramble for liquidity. It means money is getting tight, the lubricant is drying up, and the financial system is quietly bracing for a major impact. And yet, the optimists did what they always do. They ignored the signal. Stocks continued their frantic climb for nearly 2 years after that inversion. The market gained nearly 50% while the flashing red light remained active. The dangerous hubris of the age declared, "It is different this time. Our technology, our government, our prosperity is unique." By October 1929, the dream violently shattered. The Dow Jones did not just correct, it collapsed by over 80%. Unemployment soared to a devastating 24%. An entire generation learned in the most painful way possible the consequences of ignoring the quiet ancient warnings that precede the storm. TUC3. Pattern reveal, economic mechanism, and the repetition. Fast forward to the turn of the millennium. The intoxicating rush of the late 1990s. The world was again convinced of its own invincibility. The internet, the new technology, had changed everything. The narrative was that old economy rules no longer applied. Technology stocks soared to stratospheric valuations, detached from any measurable reality. But in 2000, the pattern asserted itself. The yield curve flipped again, and mere months later, the spectacular NASDAQ bubble burst, wiping out trillions of paper wealth. The lesson was learned, but quickly forgotten. By 2006, the cycle began its dark repetition, this time centered on the subprime housing market. The curve inverted once more, a silent sentinel, warning that the financial foundations of the world were under immense and unsustainable stress. Again, the markets rallied for another year and a half. The official economy looked strong. Unemployment remained low. The Federal Reserve, the supposed guardians of stability, continued to raise rates in a bid to appear in control. The chorus of denial grew louder. This is not the same as before. The inversion is a fluke. It's too flat to matter. And then, in 2008, the entire world was dragged into chaos. Banks collapsed. The global banking system teetered on the brink. Millions of homes were lost. The scale of the financial destruction was unimaginable. And once again, that single lonely line on a chart had predicted it all, patiently waiting for the moment when leverage and denial gave way to terrifying reality. The profound philosophical insight here is that the signal is rarely about timing. It is about certainty. It doesn't tell you when the crash will happen, only that it must happen, because the basic laws of time, money, and trust have been broken. Tyep Tuk 4. Modern Parallel, today's reflection and expanded context. Now, look at where we stand today. In August of 2022, the yield curve inverted for the current cycle. And the word inverted is an understatement. It has plunged to depths that not only match but in key measures exceed the inversions seen before the 1929 and 2008 crises. Crucially, it has remained inverted for a duration longer than any recorded period in modern history. The warning light is no longer flashing. It is permanently affixed to a state of maximum danger. Yet just as before every major market catastrophe, the surface appears deceptively calm. Stocks have roared back, fueled by hype and speculation. Unemployment is near historical lows. The official data still paints a picture of resilient, almost bulletproof economic strength. People look at the rallying markets, at the headlines of growth, and think, see? The signal failed. The rules have changed. But this is the same lethal illusion we have always fallen for. This is the calm before the storm. The false confidence that peaks just before the inevitable, structural breaking point. Visual. Contrast between 1970s footage of gas lines and modern footage of Amazon delivery trucks and full malls. Back in the 1970s, the inversion mechanism was swift. When the curve flipped in 1973, the economy cracked almost instantly under the weight of the oil shock. The same occurred in 1979. The signal appeared and crisis followed within months. But today, something has been strangely different. When inflation exploded and interest rates spiked in 2022, a 1970s-style recession was universally predicted. It never arrived immediately. Why? The critical missing piece of the puzzle is the COVID-19 stimulus cushion. Consumers in the world's largest economy still held trillions, over $2.5 trillion in excess savings accumulated from government aid. That artificial cushion acted like armor, absorbing the shock of high prices and high interest rates. People kept spending, businesses kept hiring, creating a mirage of invincibility. But that armor is dissolving. Those excess savings are now virtually gone. Credit card balances are at all-time highs. Delinquencies, especially in the auto and credit sectors, are rising quietly, exponentially. The invisible shield that protected the system from its own flaws is fading fast. When it vanishes completely, the true, unfiltered impact of this deep inversion will finally begin to tear through the real economy. The danger is not just the inversion itself. It is the fundamental message it transmits. The bond market, the home of cautious institutional capital, is telling us, we are terrified of the next 6 months. They would rather earn terrified of the next 6 months. They would rather earn less for a decade-long loan than risk the chaos that liquidity drying up in the short term will bring. And the deeper that inversion is, the worse the corresponding crash. In every case, the depth of the inversion has been a proxy for the depth of the subsequent recession. Shallow dips led to mild slowdowns. Deep, sustained inversions led to economic destruction. Today's inversion is one of the deepest ever recorded. 5. Outro. Philosophical and cautionary ending. Right now, the financial media and the analysts on your screen are repeating the same soothing, dangerous lines we have heard for a century. The system is different now. The data is strong. Our models are sophisticated. The rules don't apply anymore. But the profound, chilling truth is that human nature has not changed. In 1929, they believed new technology made crashes impossible. In 2006, they believed housing prices could only rise in a perpetual upward curve. And today, people believe that artificial intelligence or central bank intervention will somehow nullify the laws of economics and keep the economy alive forever. Every generation has its grand, beautiful fantasy. its unique reason to ignore the signal. And every single time, brutal reality wins. Here is the most disturbing layer to this modern parallel. The last time the yield curve was this inverted, the world was not drowning in systemic debt on this scale. In 1929, household debt was manageable. In 2008, the leverage was primarily concentrated in the housing sector. But today, debt is the oxygen of the system. Gargantuan government deficits, crippling student loans, elevated auto loans, and maxed-out credit cards. The entire global structure is built on borrowed time and borrowed money. And that means that when the cost of borrowing is forced to stay this high, sustained by inflation and central bank actions, something will inevitably and catastrophically break. This is no longer a question of if, but a cold, mathematical certainty of when. A family that borrows too much must stop spending. A business that must refinance at double the rate must eventually cut costs and fire workers. This is not speculation. It is the inexorable logic of mathematics. And the inverted yield curve is pointing directly to the moment where that math stops working. Some look at the soaring stock market and declare the warning void. But this is the final, most cunning psychological trap. The market always rises right before the fall. In 1928, the market climbed for almost 2 years after the initial inversion. In 2006, stocks hit new highs even as the economic undercurrents were screaming for an exit. The longer this delay, the longer this illusion of strength is allowed to persist, the more catastrophic the eventual correction will be. The delay convinces the reckless that the risk is gone, leading them to double down, take on more leverage, and thus fuel the very explosive collapse that is waiting ahead. This is the sound of pressure building. The moment before the seal breaks. The yield curve is not just a line on a chart. It is the voice of the bond market, the most cold, conservative, and rational part of the financial world, whispering the unvarnished truth before anyone in power wants to hear it. It is telling us that something fundamental is structurally, catastrophically wrong. If we trace the historical pattern, the 1928 inversion led to a market climax about 17 months later. The 2006 inversion took roughly 16 months. If history maintains its brutal rhythm, that window of maximum danger is not in the distant future. It is right now. In both of those past cycles, people believed the inversion had failed because the immediate, brutal reaction never materialized. But when the breaking point arrived, it hit with the force of an avalanche. This time, the impact could be truly global. We are a world more connected, more leveraged, and more exquisitely fragile than ever before. Banks, governments, and corporations are all entangled in the same colossal web of complex debt. One major default, one liquidity freeze, one unexpected geopolitical shock, and the contagion will spread everywhere. This will not merely be a market correction. It has the potential to be a structural reset of how money, credit, and power operate globally. History has never, in the entire scope of the last century, delivered a soft landing from a yield curve inversion of this depth and duration. Never. And that is why the pretense that it's different now is perhaps the most profound and expensive mistake of our time. The deeper the silence, the louder the crash. The answer is not a paralyzing fear. It is radical awareness. The yield curve does not command us to panic. It commands us to prepare. To see through the illusion before the rest of the world is blindsided. What is coming is not simply another recession. It is the inevitable unwinding of years of structural excess, reckless leverage, and intoxicating false confidence. It will shake governments, companies, and investors who thought they could outsmart the laws of the economic universe. But in every collapse, there is also the genesis of rebirth. The Great Depression eventually forced the construction of the modern financial system. The 2008 crisis forced the reshaping of global banking. And whatever comes next will do the same, clearing away what was rotten, unsustainable, and illusory. The yield curve is warning us, just as it always has. It is saying the system has sailed too far from the shore of reality, that the internal pressure is reaching its limit, and that no amount of denial will change the coming tide. Every moment of calm before a storm feels peaceful, until the first thunder cracks. And when it does, people will claim they never saw it coming. Yet the signal was right there, whispering its ancient truth all along. This time, you can see it. You can feel it. The yield curve does not lie. What is coming will not just repeat history, it may rewrite it entirely.